You're listening to Indications by the Conference Board.
Hello, my name is Ataman Özyıldırım, Global Research Chair at the Conference Board, and it is a pleasure to welcome you to this edition of the Indications podcast, a series brought to you by the Conference Board. Today, I will be sitting down with my colleague, economist Klaas de Vries. We will be discussing the latest trends in global productivity growth based on the recently released Total Economy database from the Conference Board. We'll talk about the impact of the pandemic and look ahead to the future of productivity growth. Welcome, Klaas.
Thank you, Ataman. Thanks for having me.
So, Klaas, let's get right into it. What is productivity and why is it so important?
So productivity refers really to the amount of output produced per unit of input. So it's not necessarily the same as working more. As someone would say, I was very productive today. No, it's really about how efficient or smart you've used the hours that you spend working. Now, you might ask, why do we care about this? Well, to use the words of Nobel Prize-winning economist Paul Krugman, who said, productivity is not everything, but in the long run, it's almost everything. So what he really means there is that productivity is the only sustained source of economic growth because national resources are finite, labor and capital run into diminishing returns. And also from a business perspective, productivity growth is important because it allows firms to lower prices while raising wages and at the same time maintaining margins.
But how do we measure this productivity?
So the most commonly used metric is labor productivity, which refers to the amount of labor input needed to produce a unit of output. And output is then commonly measured by GDP or gross domestic product, while labor input usually refers to the number of workers that are involved in the production process or sort of the production of that GDP. Now, ideally, however, you would like labor input to refer to hours worked so that you can adjust the number of hours because the work week differs across occupations and demographies and also across countries, actually.
Right. So these are pretty abstract concepts that economists use, but there's a very well-defined way to define and measure them. But what about differences in the skills of workers that might both be putting in the same number of hours, for example? Is one more productive than the other?
Yeah, that's a good point. So you could actually drill further down a little bit, actually. Indeed, by not only accounting for the hours spent on the job, but also, for example, by the level of skills someone has, or the amount of capital that is used in the production process. So if you account for all those elements, you end up with a concept called total factor productivity, which is also in some cases referred to as multi-factor productivity because it's opposed to what you could call single factor productivity, which is labor productivity, what we talked about before. And this measure, this total factor productivity, is a measure of the extra output that comes about through using the factors of production more efficiently and innovatively.
What are the data sources used to measure this? And what is the total economy database that you mentioned?
So yeah, as I mentioned earlier, output refers to GDP data or gross domestic product, and that's really a globally widely available statistics. It's constructed by national statistical institutes using internationally agreed upon guidelines. In most developed economies, these same statisticians provide accompanying labor and capital input data. So we can use those directly for our productivity measures. While for other countries, mostly emerging markets or lower income economies, we rely mostly on third-party research institutes to provide comparable labor and capital input data that go with the GDP output data. Now, the total economy database, what it does is it sort of brings all these data from a large number of countries together in a harmonized way. So that, for example, the number of workers really refers to persons and not jobs, as is common in some countries. Or, for example, that the capital input is calculated using the same underlying assumptions, for example, regarding depreciation rates or asset lives. So I guess it really allows for in apples to apples comparisons, or at least as best as possible.
So when you're looking at international comparisons across countries and regions, it's really important to make sure that you're making apples to apples comparisons because each country might be measuring things a little bit differently. And the total economy database will put everything on a consistent basis across many countries and regions. So these apples to apples comparisons become possible. Let's take a look at some of the latest trends you've been observing over the last decade or so. Before we go into the impact of the pandemic on productivity growth, what were the prevailing trends going into this crisis last year in 2020?
So I would say the prevailing trend really was that of a global productivity growth slowdown, which, although in some countries is worse than others, really has affected almost all major economies and regions. Now, this slowing trajectory and the growth rate of productivity, that's important to realize. Productivity growth overall is still growing, but at a much slower growth rate than we used to. So this slowing really roughly started, I would say, around the mid 2000s. So that by 2019, global productivity growth was about less than half of what it was in 2005.
This was really alarming for economists because, as Klaus mentioned earlier, productivity is really underlying the sources of long term economic growth, and it's really underlying wage growth and growth in living standards. So, Klaus, do we know what the causes of the slowdown were?
Yeah, I think the reasons differ by country and region. There are structural factors. For example, in emerging markets, I think a lot of it has to do with the slowing and the potential of catching up to mature economies. In other words, most of the low-hanging fruit has probably already been harvested. So really pushing the productivity growth frontier further is becoming more difficult, so to speak. In more developed markets or mature economies, on the other hand, I think it's for a large part simply related to a rising share of low productivity personal services within the overall economy. But you could also argue for other reasons. For example, the increased effect of so-called superstar firms, or maybe just market concentration in general, which seems to be on the rise in a lot of economies globally. So you see a small share of firms that sort of reap all the productivity rewards that are still, growing their productivity pretty rapidly, while a large subset of other firms see their productivity barely increase. And then I think finally, really coming to the last decade, so to say, I think there's also cyclical factors that played a role. Generally, the recovery from the global financial crisis of 08, 09, or the Great Depression that followed, was really a period of low demand, weak investment, and that of course also had a negative impact on productivity growth.
But how is that possible? We have seen this proliferation of new technologies and innovations in the at least in the last couple of decades. At least in the most recent decade, we've seen a lot of new digital technologies, new internet technologies come into being. I'm thinking of things like smartphones and cloud computing. Some refer to the mobile app economy. And in general, the rise of the internet and e-commerce, online shopping, and so on. And that includes improvements we've seen in the use of artificial intelligence in all kinds of new businesses.
Yeah, that is a paradox indeed. But I think we should keep in mind that there's an important distinction here we should make between the diffusion time, which is the amount of time before the technology is available to many sectors and firms, and the absorption time, which is the speed at which the new technologies are successfully adopted and start to kick in at the bottom line of better business performance. Now, I think the disruptive nature of these new technologies turns out especially hard for firms to adopt because you need organizational changes, talent requirements, and other complementary investments. And, they're difficult to manage and they don't easily or quickly translate into faster productivity growth. And this is perhaps also an important reason behind the gap I just mentioned, the gap between so-called superstar firms who are able to adopt and absorb the new technologies relatively well, and are thereby able to, rise above the rest who are still struggling to make these technologies have a profound impact on their business.
Yeah, some people argue that these numbers for productivity are not so reliable because there are important measurement problems. A lot of this, what we've been talking about, is really very new, and statisticians haven't quite figured out how to measure it and how to understand the impact on the traditional measures of economic outputs and inputs. What do you think about that?
Yeah, that's a good point. Yeah, and I mean, there has been some research, and that shows that the increased importance in digital technology really complicates the measurement of productivity. In the late 1980s, Robert Solow, which is another Nobel Prize winning economist, he quipped that you may see the computer everywhere except in the productivity statistics. No, I think today you may say the same thing about digital technology. For example, we may not capture these quality adjusted prices of digital investments that well. We struggle, by including the value of free content in our statistics. Another example is the rapidly declining costs of cloud computing services that have become ubiquitous. And not to mention the smartphones and tablets that everyone seems to be carrying these days. So these measurement problems may not be that much as some have argued, that it really, sort of the whole productivity slowdown disappears. But yeah, I agree that better measured productivity could be, indeed somewhat faster than we currently assume.
And also, there could be offsetting positives and negatives as well. But I think the point is we don't exactly know. And there are some firms that have really figured out how to live and create value in the digital world. Some have been born in a digital world, but others are still playing catch up and figuring out how to create more value and improve their performance with these new technologies. Well, thanks for that, Klaus. We are going to take a short break for some quick announcements from our colleagues, and we'll be back in just a minute to continue. I'm speaking with my colleague Klaus de Vries, economist at the Conference Board, and we're discussing the latest global productivity trends.
Interested in this content? You can find this and much more at our Conference Board website, www.conference-board.org. Or, even better, contact our membership team and your company can enjoy the benefits of our in-depth research around the economy, environmental, social, and governance issues, public policy, marketing and communications, and human capital. As a member of the Conference Board, you will be able to have full access to all of our cutting-edge research, leading indicators, benchmarking, and data services, in addition to webcasts and podcasts such as the one you are enjoying now.
Welcome back. I'm Ataman Özyıldırım, Global Research Chair at the Conference Board, and you're listening to the Indications Podcast, a series brought to you by the Conference Board. Today, I'm speaking with my colleague, economist Klaus de Vries, about global productivity trends. Klaus, so let's pick up where we left off on productivity trends and the latest development in 2020 with the pandemic recession. And we're getting to the economic impact of the pandemic. Did productivity growth in 2020 decline because of the great lockdown of the world economy? And we see these huge declines in almost every other economic indicator. What happened to productivity growth in 2020?
So in terms of output per person employed, yes, global productivity growth declined in 2020. Indeed, as you mentioned, as many other economic indicators did. We estimate the decline at about 1%, which is similar to the fall observed in 2009, which was sort of the last big global economic crisis. And this 1% was the result of a drop in global output of about 4% and a drop in employment, which was about 3%, a bit smaller.
But is persons employed a good measure to use for 2020? We know that many workers across the world's economies remained formally employed or furloughed, but they worked much fewer hours despite that.
Yeah, that's a very good point indeed. I mean, as you indeed mentioned, many workers were furloughed, and so they remained technically employed. They would show up in the statistics as being employed, but of course, they drastically reduced their working hours. In some cases, this was encouraged by government wage subsidy policies. And this was done because business anticipated a rapid resumption of activity once these lockdowns were loosened and normal mobility levels returned.
So, what do the data on hourly labor productivity tell us?
Yeah, that's really interesting because it shows quite the opposite picture actually of the output per worker, which, as we mentioned, saw a decline. But total hours worked declined much faster than GDP. I would say almost by a factor of two. So as a result, hourly labor productivity grew by almost 4% in 2020, which was quite similar to the recovery year of 2010 when the global economy was recovering from the financial crisis. So in other words, those hours that were worked in 2020 were highly productive, you could say.
So, what's behind this rise? Did these workers suddenly become so much more productive during the pandemic, seemingly overnight?
Yeah, that's a good point. I mean, and on aggregate, yes, but there's a big caveat, of course, that the aggregate for 2020 may not be very representative when you compare it with 2019. And this is because the pandemic recession disproportionately hit service sector activities, and especially those services that employ a large share of low-skilled and low-productive activities. So as those activities sort of dropped out of the sample of 2020, that raised the overall productivity level of that year. And that's probably also the reason why we expect 2021 hourly productivity growth to disappoint a little bit, because those services are expected to continue their recovery as economies transition towards a more normal state of affairs. And as I said, this should dampen hourly productivity growth somewhat for the ongoing year.
So, this suggests we have to be really careful about some measurement issues, especially for these 2 years in 2020, 2021, and maybe looking ahead as well. So, as opposed to this so-called allocation effect between, which sectors are being affected the most, do we have estimates of the direct contribution from each industry's productivity growth? That is organic productivity growth within an industry, driven by an improvement in the performance of the firms, driven by technology, skills and efficiency, and so on.
Yeah, indeed. That would be the measure of firms and workers actually getting better at what they're doing in spite of the pandemic-induced disruptions. However, to do these calculations, you need detailed productivity data by detailed industries. And usually those data come out with quite a lag, usually 1, sometimes 2, in some cases even 3 years before these detailed data are available. However, we did do some preliminary exercise for a couple of countries for 2020, and we found actually that this sort of direct productivity growth or within firm productivity growth in the US was about 1 full percentage point below the headline number of 2.5%. In Europe, however, headline productivity growth was barely positive, was really around 0.5, depends a bit on the country, but for most countries it was really around zero. And that means that the direct or the within firm productivity growth was negative.
Well, we know from anecdotal evidence, speaking with conference board members, that some of them had to pivot very quickly and figure out new ways to continue working. And telework was part of that, but there's really much more behind that in terms of carrying on operations and meeting their customers' needs. And it sounds like there were some differences among the US and European firms, which then show up in some of the aggregate data as well. Yeah, as I mentioned, a big change for 2020 was the shift towards teleworking or remote work policies. We all had to go through this, a majority of the workforce. Do we know if this was having a positive effect on productivity?
Yeah, so indeed, employee productivity in a remote setting, that is indeed a major concern for management. However, so far, I think there's no clear consensus yet among executives about whether working from home has been very successful, even though I think you can argue that it has gone much better than expected, both for workers and for employers. Now, taking a bit more of a high level perspective, I think there are sort of two offsetting forces here, and each firm will sort of have to decide which one it thinks is more important. Because on the one hand, teleworking can be productivity enhancing because it allows for an increased talent pool to hire from, right? Because workers do not necessarily need to live close to the office anymore if they can, work remotely. They can work from anywhere. So should be productivity enhancing because you can get the best, the best suited skills for the task that you need to do. But then on the other hand, we know from the literature also that having people in the office is typically good for productivity and innovation because, workers gain skills by learning from and interacting with each other. However, you could also argue that there are further advancements in technology, in remote presence. So there is a potential for these two factors to complement each other rather than working against each other, as seems to be the case more or less of our current state.
Yeah, that's very interesting, and we'll see what happens when the dust settles and the overall impacts really emerge very clearly. That's actually a good segue into our last segment. We'll talk about how productivity rates might look like in a post-pandemic world. Will the slowing trend from before the pandemic return, or are we at a new inflection point? What do you think, Klaus?
Yeah, so I think we need to distinguish between the short and the long run, because probably in the short run, we'll have a strong recovery of demand. As consumers spend their excess savings, business will ramp up their investment to meet this demand. And that will probably lead to a temporary boost in productivity because a lot of these businesses, they will go back to normal levels of capacity and perhaps temporarily even slightly above this. And that should really provide a boost for productivity growth in the short run. However, in the longer run, the supply side factors, which are really, how are things produced, where are things produced, those factors will become more important again. And here, I think the prospects are a bit more uncertain, more difficult to argue either way, I would say.
Yeah, can you talk a little bit more about those supply side factors?
Sure. Well, some of it has to do with working from home, as we already discussed before. For example, I mentioned the loss of collaboration, the lack of effective innovation in the remote working environment. But others are more broadly related to the lack or the loss of workforce skills, for example, because of a hiatus in education or increases in the long-term unemployed. Finally, the amount of creative destruction or business churning, as new firms entering and less productive or so-called zombie firms exiting the market, that will also determine for an important part the productivity growth in the longer term.
But what are some of the upsides?
Yeah, so I think the most obvious one has to do with the acceleration and more widespread use of digital technologies and the data they produce to connect organizations, people, physical assets, and processes. So this digital transformation, you could say, as opposed to mere digitization, where you simply buy more technological tech goods, so to say. But this digital transformation, which is a much more holistic process, so to say, that was already underway before COVID-19. but it has probably been greatly accelerated. That really means that we may also see the benefits of this transformation sooner than we would have expected otherwise.
Well, that does point to potentially a very significant upside for the world economy, really. Thank you very much, Klaas, for taking us through some of the latest developments in global productivity growth. If you would like to go deeper or check out the data for yourself, please visit our website. The link will be available from the show notes. You will find tables and charts highlighting the latest release, as well as the underlying productivity data for over 130 countries, with time series starting as early as the 1950s. I'm Arman Özyıldırım, and you have been listening to Indications, a podcast brought to you by the Conference Board.
This has been Indications from the Conference Board.